on August 12th, the latest CPI reading painted a mixed picture. Now, the headline CPI came in below expectations at 2.7%, while core inflation, which excludes food and energy, was hotter than anticipated at 3.1%. Now, despite the higher core inflation, markets seemed to focus on the softer headline number. S&P futures rallied over 0.5%, and the two-year Treasury yield dipped from 3.77% to 3.72%. Now, this CPI release was highly anticipated because it followed the weak unemployment data published on August 1st. Investors had been hoping that concerns about a softening job market would be met with evidence of a moderating inflation. Historically, weaker labor data helps curb inflation. However, as Federal Reserve Chairman Jerome Powell recently noted, certain exogenous factors like tariffs could act as an unexpected variable, keeping prices elevated even as job growth slows. So in the hours leading up to the report, futures markets had priced in an 82% chance of a 25 basis point Fed rate cut at the September 17th FOMC meeting. Following the release, that probability jumped over 90%, and traders began to price in over 60 basis points of cuts before the year's end. Equity markets generally welcome lower rates as long as they are not a response to a severe economic downturn. So far, economic concerns seem to be limited to job data and not the broader picture. So CPI is just one piece of the puzzle, though. The PPI number arrives on the 14th, and with the recent uptick in core CPI, this number will receive extra attention. The retail sales report on the 15th will also provide insight into the health of the consumer. Last month's retail sales were stronger than expected, contrasting the recent softness in the labor numbers. As new data is released, investors will be watching to see if the consumer spending can continue to drive the economy or if cracks are starting to show. So, if a trader believes that stocks could continue higher from here, they could express that by buying the September micro E-mini S&P 500 contract at 6448 and target a move to 6550. Now, a stop for this trade could be placed below at 63.90. This trade could make $510 if the target is reached and risks $290 if you're stopped out of your level. Now, if a trader believes that stocks could head lower from here, they could express that by selling the September micro E-mini S&P 500 contract at 64.48 and targeting a move back to the August lows of 62.40. Now, a stop for this trade could be placed above the psychological level of 6,600. This trade can make $1,040 if the target is reached and risk $760 if you're stopped out of your level.